From New York City for our viewers worldwide, I'm Sonali Basak, and Bloomberg Real Yield starts right now. Coming up, Fed officials preached patience on rate cuts. And investors are breathing a sigh of relief after a modest revision to U.S. inflation. And key Treasury yields, they're reaching 2024 highs as the economy stands strong. But we first begin with the big issue, the Fed pushing back on rate cuts.
You've got a number of Fed commentators out there really pushing back.
Pushback on the rate cuts.
I think the Fed has clearly signaled they're done raising interest rates.
Is locked and loaded to cut rates if needed.
Is on a wait-and-see approach.
Wait until inflation data really gives them the confirmation that they want to see.
The committee is a little just, struggling to catch up to how quickly the data have moved.
The one variable that the Fed is looking at is core CPI. And what we've seen over the last few months has been core CPI coming down.
They have scar tissue from this inflation of the last couple of years.
The economy's been extraordinarily strong, so they have the luxury of waiting.
We need to see more data before we can decide, when exactly they're likely to cut rates and by how much.
There's really no rush for the Fed to come in and cut rates soon.
Now, with those changing expectations about rate cuts, I wanted to point out a particular point of the curve. I wanted to talk about the 10-year. You are seeing Treasury issuance happening at the longer ends of the curve, the 10 years, the 30 years, and you're seeing a lot of volatility along the way. So what are we seeing exactly? About 6 months ago, you had the 10-year really breach that 4% level and ride much higher, hitting 5% in October of 2023. Now, you've marched down quite significantly since then, hitting below 380. But you've since seen that march higher yet again. We are now standing at nearly 419. We are higher than levels than we were 6 months ago, if you can believe it. And that all comes on the heels of changing expectations for rate cuts. So what are those changing expectations? Let's flip up the board here and talk just about how those March expectations, they're pretty much off the table, according to what you're seeing traders bet on in Fed futures. But May is where things get really interesting. You are starting to see basically a coin toss here in what traders expect in terms of a May rate cut. Now, will we get 5 rate cuts? There's a lot of dispute about this, but where traders place their bets heading into this uncertainty is of a critical question and the money they make or lose along the way. Now, Richmond Fed President Tom Barkin added to the chorus of official urging patience on those rate cuts.
Gratified to see inflation coming down, hoping it continues to come down, and I think we've got some time to be patient. If I could get these kind of numbers sustained and even better broadened, that's what I'm looking for, sustained and broadening.
Joining us now is Katy Kaminski of AlphaSimplex and Lexlie Falconio of UBS. Katy, we were talking about the May rate cut really being a 50-50 chance when you look at markets today, looking at futures markets. How psychologically important is that May meeting now, given that we're seeing the rate cut expectations starting to subside in the market?
Well, I think that what's happened is people have just shifted focus from March to May as the next big target. And so I think that's why it's such an important point, because we're going to start seeing more data before then. We were getting good CPI numbers this week for December. And, I think it's really a question of having more confirmation. The market just frankly got a little bit ahead of itself after what happened at the end of last year.
Lexlie, when you think about just even the data we're seeing next week, when you look at inflation, how can what we see next week start to change the story of what we're thinking in markets in the future?
Well, I mean, given the fact how much we've moved this year, and our expectation was the first cut wouldn't be until May. And we still think that May will be the first cut, although the market is now putting a lower probability on that and moving to June. Does May, June really matter to us? No, not really. I mean, but one of the things that the market is really somewhat coming complacent with is the fact that, CPI will continue downward. We know that there's a lag with OER and housing. We know auto prices will probably fall. But I think a thing to remember is the Fed looks at PCE, and while we have the 3 and 6 month below 2%, the 12 month is still at 2.9%. So that's one of the reasons why we thought a March cut was way too soon.
Katy, how do you think about where you start to reassess your wagers along the curve, given the volatility we've seen?
Well, I think this has been one of the biggest things we've been watching. If you look at stock bond correlation, it's still persistently high and positive. But also, and everybody's really feeling this, there's sort of a back and forth in the fixed income markets. There's buyers on one side ready to get higher yields, but there's also, push towards we're going to get cuts at some point. So you're really seeing a lot of mixed signals, and that is resulting in a lot of intraday volatility and a lot of back and forth in the fixed income market.
How do you play that volatility, Lexlie? Are you comfortable getting out on duration with that kind of volatility seeped in?
Well, we are. And, Katy made the point, and this is true, is that the difference between, like, say, 2024 versus 2023 is that investors do have that buy the dip mentality. Maybe it's 4.25 10-year yield, maybe it's 4.5. But I do think that, investors are fairly confident, at least with the data that we have right now, that the Fed will cut. Whether it's May or June is really not relevant. And I do think the fact that we do, in our opinion, we do expect, growth to slow to around that 1.5–2% level. We think inflation comes down, but we are more in that soft landing camp. So we do believe that, locking in these yields, taking that carry for the long term, whether it's 4.25 or 4.5, will really be that driver of total return.
It's interesting when you think, Katy, about just how many people have been piling into the duration. Do you start to think past the 10-year into the 30 at this point?
Yes, I think we've seen long signals more recently across the whole curve, less so on the short end recently, but you're definitely seeing people starting to say, well, if I do believe that things are going to go back down, that we're going to see lower rates, maybe it's not so bad to lock in some of these rates today and get that carry and get a higher yield and hold on to it.
Lexlie, if you think about the thinking that rates will fall, these are good entry points to buy in, what is the biggest risk to the people who are piling into duration today?
Well, there's obviously geopolitical is a risk, right? If in fact we see some sort of reinflation signal, that's a risk. And there's no question. That's one of the reasons why one of the things that we hold are tips. Right now, we went long tips and when real yields were, say 5-year real yields are on that 220, 225. So obviously real acceleration inflation is a risk. Geopolitical concerns are a risk. But even if I think, and the Fed stated this, even if the labor market remains relatively tight and GDP remains relatively strong, as long as there's not a reacceleration of inflation, they would still be willing to cut. And I think that's an important point.
Katy, when you're thinking about the idea of reacceleration of inflation, what are you looking at most, given the volatility around oil prices, around shelter prices and wages, in addition to all that?
Well, what we've seen from a cross-asset perspective is we've seen tremendous downward pressures in the raw commodity sector, with the exception of energy. So if you look at things like wheat, corn, a lot of those raw commodities have really seen a major drawdown in terms of prices. But what I think is the worry from our side is also watching a little bit the role of China in that particular demand story, and how much of that could be eradicated if we started to see China come back online and have some sort of stimulus. So I think it's really watching the commodity prices and how they're connected to the inflation narrative, and also watching energy, which has been on the upswing because of a lot of geopolitical uncertainty. So there's definitely room that could happen, and that would sort of put a damper on this disinflation narrative that we've seen in the data.
If you see any signs of reinflation here, Lexlie, you've already seen even the 2-year start to, let's say, drift higher. It hasn't been drastically swinging in the same ways we saw one-day moves last year. We have seen some of that. If we see signs of it in next week's report or in any other reports, frankly, how much can the market start to reprice?
Well, look, it would have to be more than just next week's reports, but we are seeing things like, home price appreciation, which is also, something that we need to monitor in regards to inflation. I don't think these sort of 1 month are going to be an issue, but fortunately now the market's pricing in about, say, 117, 120 basis points of cuts for 2024, and this is from 175, 180. So it's come a long way. Again, we feel that it'll be about 100. So if in fact it comes out stronger, could you move towards that SEP projection of 75 basis points that the Fed has been dictating? Probably, but I think it's really more about the sustainability. So I think around 75, 100 is where the market would go to, but more than likely stop at 100 basis points of cut. So you'll see the 2-year rise in that, but I don't think materially, nor do I think it'll be sustained.
Katy, a lot of people, and you included, have been talking about trading steepeners at this point, given we've seen such a prolonged inversion. How long is that opportunity, and how fruitful is it for investors looking in to get into the steepening trade?
So this is a good question, because at the end of last year, as soon as everyone thought, okay, we're at the end of the hiking cycle, it was just all this talk about steepeners and let's get in a steepener. And I think those positions haven't really realized that opportunity. And it has to do with the fact that this is a very different scenario, that it's not clear that the Fed is going to go ahead and cut anytime soon, at least later this year. So that type of steepener trade will be profitable at some point, but it just really may not have been the right entry point yet.
Leslie, if you think that rates might stay just a little higher for a little longer here, this idea that we may not see as many cuts as the market initially expected, we've seen issues already come to the surface. Think New York Community Bank, think issues with commercial mortgage maturities, and even some fallen angels really becoming of concern. What else breaks this year if rates do not see the type of cuts that the market initially expected?
Look, I mean, I think CRE is one of the big ones, right? If in fact, interest rates and the curve stays inverted, higher for longer, that could be a problem in terms of some of these loans coming due, the amend and extend. I mean, that's one of the, I think, issues with commercial real estate right now. I mean, when we came into the year, and the market came into the year from, November, expecting, okay, the Fed's going from pause to pivot, and it priced that in. There was a lot of tailwinds to performance and risk assets. I think the issue and the headwind to that would be if, in fact, the curve stays inverted, it does stay higher for longer. And when some of these loans start to come due, and that amend and extend could create some problems, just simply from the higher cost of capital.
A lot of questions about that inversion. Katy Kaminski and Leslie Falconio, we have to leave it there. Thank you for your time. Up next, we're going to talk about the auction block. Fresh off its IPO, Amerisports joins the issuance parade with its offering today. A look at the credit markets up next. This is Real Yield on Bloomberg. I'm Sonali Basak, and this is Bloomberg Real Yield. It's time now for the auction block, where the story remains the same. Sales are happening at a blistering pace. In Europe, UBS was once again able to draw in high demand for a sale of AT1 notes. The firm sold $1 billion and pulled in nearly $12 billion of orders. The offering came shortly after the bank outlined a plan to raise as much as $2 billion of this type of debt this year. And over in the U.S., investment grade, over $41 billion sold this week, and those sales blew away estimates for as much as $30 billion. You had big names with sales ranging from Citigroup to Cigna to Morgan Stanley. And in high yield, borrowers are still taking advantage of favorable funding costs. We saw the likes of Wynn Resorts and Amerisports with sales driving this week's volume to over $8 billion. Now, Maureen O'Connor of Wells Fargo talks about why banks are a big driver of issuance this year.
What you saw in January was a lot of bank supply. So they're rushing into the market at a time when spreads are trading at cyclical tights. And it makes sense, right, to take advantage of these really strong demand dynamics and maybe front load some of your issuance plans for 2024, especially considering all the catalysts for volatility in the horizon over the course of this year. But you also have an environment where, we remember where we were in October of last year, where yields were 100 basis points higher than we are now. So even our coupon-based issuers are recognizing an opportunity here to de-risk some of their funding plans and get in before things maybe start to change, especially on the spread front, where there's clearly going to be more downside to upside potential.
Let's now bring in Lotfi Karoui, Chief Credit Strategist at Goldman Sachs. You think about the issuance that we've been seeing, and you think about what we heard from Wells Fargo, front-running, really more economic data. How much are issuers just trying to get ahead of potential trouble at this point?
I think a lot of it is pre-funding, but you're absolutely right. We've had a very impressive start to the year in terms of primary market activity. In IG, we had the busiest January ever with close to $200 billion of supply. To me, there's been really two key takeaways. One, that is, to a very large extent, a natural response to lower yields. Remember, we were at 5% on the 10-year treasuries back in late October. We're a lot lower than that today. But more importantly, I do think it reflects a much more predictable path of monetary policy and more comfort vis-a-vis the durability of the cycle. And I think those two things have played a big role. It's also a very positive development with regards to the low end of the quality spectrum, those high yield companies that have to address upcoming maturities. So the appetite is actually quite strong on the issuer side. Second takeaway to me, that has been met with very strong demand. You see it in the performance of the secondary market of spreads, but you also see it in new issue concessions. Those bonds typically come at a slight discount relative to the secondary market. That discount has narrowed quite dramatically.
Let's talk about spreads for a second here, because our investors are really getting compensated for the risks they're taking on, given where spreads are.
Look, spreads are tight. They are at the tight end of the historical range if you go back to a decade or even 2 decades of history. Are they being compensated? It depends on your view. They're definitely not pricing in a recession. They are pricing in what I would typically describe as cycle extension, and so mid to late cycle type of environment here. But spreads are tight. There's one difference: yields are higher, and so I think we need to look at credit certainly as a spread product, but also as an all-in yield product.
Let's talk about where those higher yields matter the most, the riskier end of the market, because you're watching investors feast on high yields like there's no problem. And even if you don't see a recession, they are faced with higher costs of interest. Can they all survive through those higher borrowing costs? And are investors perhaps discounting the idea here that things could go wrong?
I think for the high end of the quality spectrum, the answer is probably yes. If you're a double B or a single B rated credit, I think, yeah, you still have very healthy debt servicing capacity, even if you factor in potentially some kind of a long run equilibrium level of 4% on 10-year treasuries. For the low end of the quality spectrum, the answer is it depends. And you really have to look at it on a case by case basis, sector by sector, sometimes issuer by issuer. Yields have come down. The market is actually open even for CCC rated issuers. We've had a handful of deals this year, which is a big change relative to last year. But dispersion, I think, within the low end of the market is likely to remain high.
It's worth talking about even messier parts of that low end of the market. You think about what we've seen the last couple of weeks with New York Community Bank, regional bank issues, as well as commercial real estate issues. How do you parse through the noise in those very messy areas right now?
Yeah, I mean, great reminder that the challenges in the U.S. commercial real estate market are going to linger for quite some time, and they will have an impact on lenders, not just in the U.S., but also in Europe, by the way. I do think it's important to keep in mind that the commercial real estate market is a very diverse asset class. You know, there's office properties, there's the rest. I think the rest of the market, by and large, has strong fundamentals. And I also think that the bar is still very high for the U.S. commercial real estate market to become a catalyst for an escalation in systemic concerns. And so I know we've used the word idiosyncratic ad nauseum, you know, the last couple of months, but I do think that there's a big element of idiosyncrasy in some of these headlines that we've seen the last 2 weeks.
How do you think of a headline that crossed the terminal this week about fallen angels? The debt load is spiking among them globally to more than $400 billion. Do you think investors are really not calculating the idea of credit quality starting to worsen for some of these issuers?
Well, credit quality did inflect a year and a half ago already. The pace of the deterioration, however, has been very manageable. And a lot of that, I think, speaks to the fact that going into the hiking cycle, corporate fundamentals are in very good shape. We are actually not that worried about a potential wave of fallen angels in 2024. A lot of that is predicated on a positive macro view, robust growth, continued disinflation, and then easing, starting in May. Last year was a very impressive year in terms of rising stars actually dramatically outpacing fallen angels. I think we'll normalize a little bit this year, but we're not concerned about a wave of fallen angels.
Well, it's interesting. What I'm hearing for you is a lot of sanguine tones about the economy, about these issuers. Is this a reflection of it being the year for credit, of it being really the year of fixed income outperforming?
On a risk-adjusted basis, yes. I think one of the big differences between 2024 and 2023 is that vol in the rates market should come down dramatically. Remember last year, everyone had a very wide range of outcomes as to where Fed policy was going to go. This year, that range is a lot lower. Really, the only uncertainty is about the timing of the first cut and then the magnitude. But the risk of another large monetary policy shock has declined dramatically. That's a big boost, I think, for risk-adjusted returns. Absolute returns will be lower. The starting level for spreads is just tighter than last year.
So most mispriced opportunity in your view?
the low end of the quality spectrum in high yield. The analog to that would be small caps in the equity market. But you have to look at pockets of the market where the soft landing premium is actually still there. It's not there at the index level. The index is tight. You have to scratch under the surface and really look at the low end of the market. But there's value in those CCC credits in our view.
Wall Street putting the analysts to work. Lotfi, thank you so much for your time. That is Lotfi Karoui of Goldman Sachs. Still ahead, stick with us, the final spread. The week ahead, a big week ahead. All eyes on the latest CPI print. Stick with us. This is Real Yield on Bloomberg. I'm Sonali Basak, and this is Bloomberg Real Yield. And it's time now for the final spread, the week ahead. Coming up Monday, we're going to get a lot of Fed speak from Tom Barkin and Neil Kashkari. And Tuesday, all eyes will be on the latest CPI print, all eyes on inflation. Wednesday, hedge funds are set to disclose their quarterly 13F filings. And remember, more hedge funds have been buying more ETFs tied to that bond market. And Fed speak is more in the pipeline later in the week with Austin Goolsbee and Michael Barr. Thursday, we're also going to get U.S. retail sales. And finally, Friday, we'll get U.S. PPI data. And for my final thought, let's take a closer look at those CPI estimates here because we are getting closer, according to investor expectations at least, to that 2% level. The last read we've gotten a year ago was 3.4%, really starting to barrel down. And the estimate of 2.9%, of course, is meaningfully lower than that. Year over year, core CPI expected to come in at 3.7%. And of course, we have core CPI month over month coming in at 0.3%, according to expectations. Let's see, because we know there's a lot of concern out there about a reacceleration of inflation, and we may have some interesting moves in the bond market if we don't see either meeting those expectations or more signs of areas that might see room for issues. That does it from New York. Same time, same place next week. This is Bloomberg Real Yield, and this is Bloomberg.